Okay, thank you.
You want to be over here by it?
Sure.
Thank you, Paul.
Yeah, that'd be nice. Thanks.
Thirsty panel, I'm sorry. Thank you.
Before we begin the second panel, I do want to take care of one housekeeping matter. We do have the formal statement of the Canadian Transportation Agency in this matter, and it will be put into the record. Now, turning to our second panel, we're delighted to have a distinguished group today representing the Association of American Railroads, Mr. G. Paul Moats and Mr. Bruce E. Stengel. Welcome. We have from the Western Coal Traffic League, Mr. Robert D. Rosenberg and Mr. James E. Hodder. And we also have Mr. Charles W. King from the firm Snavely King, Majoros, O'Connor, and Lee. And we also are delighted to have Mr. John Ficker and from the National Industrial Transportation League. Welcome, and unless you've worked out an alternative order, we can start with Mr. Moats.
Thank you, Chairman Nottingham, Vice Chairman Guthrie, Commissioner Mulvey, staff. Good morning. Appreciate the opportunity to be here. This is a unique opportunity for me. I've had a chance to address the board many times, but I've never been surrounded by the railroad's friends like I am today. So this is very comforting because I know that all of the railroad's friends have in mind the health and success of the railroad industry just as much as the Association of American Railroads, whom I represent. And I'm sure we'll all be singing off the same page of the hymn book. As you note, Mr. Chairman, with me this morning is Dr. Bruce Stengel of Analysis Group Incorporated. Dr. Stengel is a colleague of Dean Glenn Hubbard of the Columbia Business School, the former chairman of the President's Council of Economic Advisors. As you know, Dean Hubbard submitted a statement which is in this record in December. Unfortunately, his schedule did not allow him to be here on this hearing date, but as you will hear from Dr. Stengel, they worked very closely together both on the December statement and on this current statement that is being offered, and fortunately Dr. Stengel's schedule did permit him to be here today. So I'll take a few minutes, if I may, and lay out basically the AAR's fundamental position. Then I'd quickly like to make just a comment or two, if I could, on the prior speaker from the Fed, and then ask Dr. Stengel to make some particular observations, and he has a few exhibits that may help focus our attention on his observations on the DCF versus CAPM methodologies. I hope those exhibits have been handed up. I did provide them to the Secretary beforehand, and I think we have some extras for the staff. If anyone else needs one, let us know. We can bring them forward. Our position is fundamentally as follows. There is nothing in the record of this proceeding that justifies, let alone requires, the board to discontinue its 20 to 25-year use of, yes, you're right, Commissioner Mulvey, the forward-looking DCF methodology for determining the railroad industry's cost of equity capital. The CAPM alternative advocated by WCTL and others is based upon backwards-looking data. There's really no controversy about that. The prior speaker confirmed that. And we believe, therefore, lags developments, important developments in the industry. The mere fact that there is an increase in the cost of equity in a single year or two, as there was, as WCTL points out, between 2004 and 2005, we don't believe constitutes a proper basis for the board to discard the DCF methodology, which your predecessor, the ICC, adopted only after very careful evaluation of extensive evidence and argument, including, importantly, opposition by shippers to the CAPM methodology. As you have noted several times in this proceeding, and most recently this week in your decision in ex parte number 558, denying the petition for reconsideration of WCTL to your 2005 cost of capital findings, there is a norm of regulatory certainty that is a fundamental underpinning of sound policy. And efforts to alter that norm in order to perceive short-term benefits for a particular party should be very strongly resisted. Again, we believe there is no basis in this record to replace the DCF methodology as the most appropriate vehicle for determining the railroad industry's cost of capital. However, I have to be a lawyer here for a minute. If the board decides there exists a sufficient basis to examine some of the criticisms raised of the DCF methodology, then we respectfully submit you must issue a formal notice of proposed rulemaking indicating what proposals you're considering adopting and why, and then afford all interested parties a full and fair opportunity to comment on these proposals. In saying that, I don't understand the board to have a different view. As I said in your decision on Monday of this week in Ex Parte 558, you said a couple things that I think are worth repeating here today. First, with respect to WCTL's contention that it had demonstrated on the record there that the DCF methodology is fatally flawed, you said, quote, "We properly determined not to depart from long-established methodology in this proceeding unless a party presented compelling evidence that it is flawed. WCTL has not made that showing. Rather, it attacks the methodology based on its results," end quote. And again, in page 5 of that decision, you said the record does not support a departure at this point from our precedent without further comment and study. I respectfully submit that the record of this proceeding, Ex Parte number 664, as was the case with the record in Ex Parte 558, does not contain evidence that the DCF methodology is flawed, let alone fatally flawed, and that it should be replaced or modified. Frankly, and not to make light of this, but I'm thinking about the position that WCTL and some of the other shippers have taken. It reminds me a little bit of the measuring stick you see in amusement parks at Disney World and places when you go up to the ride and there's a stick and you have to be so high to ride the ride, and everyone says that's the right point on the stick. We've studied the safety and whatever concerns they have about this ride, so you've got to be that tall. But over time, we're not getting to ride the ride, so the answer is let's get a new stick. Well, I would submit, it's not a perfect analogy, but I would submit that isn't what we do. Just because, and maybe somebody actually did grow high enough to get up to that mark on the stick, that doesn't mean there's something wrong. It doesn't mean we have to throw out the measuring stick. Now, you've asked in your notice, very pointedly, have there been important changes in the fundamental economic structure of the railroad industry that should cause us to have to look at changing and perhaps discarding the DCF methodology? Well, obviously there have been important changes in the industry, changes that have resulted in, as you well know, in notably improved financial performance by all the Class I railroads. Not all at the same level, obviously, but there has been a rising tide. And the markets, in turn, have taken note of that fact. And there has been, as a result, improved performance of rail stocks and bonds. And that is a good thing, and we're very happy about it. But those changes in what your notice termed underlying railroad economic conditions, consisting of such things as stronger demand for transportation services, especially from such sources as increasing Asian imports and the accompanying growth in intermodal traffic, increased demands for Western coal from the Powder River Basin, demand for housing and construction materials and the like, do not in and of themselves demonstrate or suggest any weakness or deficiency in the DCF methodology. Does one of us have a BlackBerry in their microphone here? That shouldn't be. And as you are well aware, and I think Chairman Nottingham, as you indicated in your opening remarks this morning, this isn't simply a matter of academic interest. And I'm not suggesting it's of academic interest for the Federal Reserve, but I think you just heard that certainly the context in which they were considering this issue of whether to apply, what methodology to apply for calculating the cost of equity there was, as the speaker said, for purposes of determining the equity of what he called a mythic entity. Kind of made me think, well, we have mythic entities here sometimes. They're called standalone railroads. We see them in rate cases. And, we have enough problems with standalone rate cases, but think about if you had to determine the cost of equity of a mythic entity that's standalone railroad. But you don't have to do that. As Vice Chairman Buckley pointed out very clearly, the members of this association are real. We're here. We're ongoing entities. Our stocks are all publicly traded. There are analysts who follow these stocks very, very closely, and no, they're not all of one mind, which I would suggest means that there really isn't bias. Or if one guy turned out to be biased, that one individual's projection would be, particularly the way you use the IBES index, would be kind of overwhelmed by the broader market indexes for the rail industry. The cost of capital not only plays a role in investor expectations about the returns the railroad should be permitted to earn, so long as our rates to market dominant customers remain subject to regulatory scrutiny, and they of course do. But it has, as you noted earlier, Chairman Nottingham, significance in the context of rate cases and abandonment cases and trackage rights fees and the other things you mentioned. But also importantly, it has a very important role in the determination of IRC's costs. In fact, we believe it is entirely plausible, and I don't mean this to be accusatory, I mean I think these gentlemen are thinking, that WCTL's efforts to convince the board to jettison the DCF methodology could be motivated at least in part by its desire to have the board embrace a methodology that might well, at least at this point in time, result in a lower cost of capital for inclusion in IRC's costs. And such a result would, of course, potentially benefit shippers in rate cases where IRC's costs play an important role in your determination of jurisdictional costs, both for market dominance determinations and for purposes of establishing a floor and rate prescriptions, but especially in light of your proposed simplified procedures in ex parte number 646 that we were all here about 2 weeks ago, in which IRC's costs will play an even more prominent role. As you know, the cost of capital is the primary factor for determining the return on investment component of those IRC's unit costs associated with a railroad's net investment base. So obviously, very important role played in the annual determination of revenue adequacy, but a very important factor in determining unit costs in IRCs. It would be, we submit, unsound public policy to abandon a proven, long-used methodology for calculating the cost of capital in response to perceived advances that the railroads may be making towards that elusive goal of long-term revenue adequacy. In fact, that kind of an approach would run afoul of the same concerns that the ICC identified in 1993 in ex parte, in 1986 in ex parte 393, which I participated in, of denying railroads pricing flexibility they need in order to achieve that goal of revenue adequacy simply because they're making progress towards achieving it. As I know you very well understand, the demands for enhanced capacity, improved service, and other infrastructure improvements facing the rail industry today require very significant capital commitments. The statistics I know are familiar to you. We've noted in our comments the DOT has predicted demand for rail transportation increasing by 55% by 2020. AASHTO projects freight tonnage up about 57% over that period. This industry and all of the entities and constituencies that are related to it and dependent upon it have a joint interest in seeing that there is sufficient capital available to the members of the industry to address those very significant capacity concerns. We have been meeting those capital commitments for the past several years, and we are doing so now. I noticed that Traffic World magazine in its February 5 edition indicated that the 5 Class 1 railroads, Union Pacific, Burlington Northern Santa Fe, Norfolk Southern, CSX, and Canadian National, those 5 together, have announced capital expenditure plans for 2007 of just under $10 billion. In the face of those kinds of commitments and needs, any changes in the methodology used to calculate the cost of capital with its resulting impacts on the ability of the industry to achieve sustained levels of revenues needed to meet those kinds of challenges must be approached with great care. Now, I want to get to Dr. Stengel, but if I may, just 1 or 2 observations, again, about the prior speaker from the Fed. And I think you all certainly queried him a couple of these points, but we think obviously a very, very significant difference is the purpose for which the Federal Reserve is using that CAPM methodology for the determination of these user services that get charged for this mythic entity. I'm now in no position, and I'm not intending to comment upon whether that decision was prudent for the Fed. Not my area of expertise. Obviously, they've concluded that it was. I would suggest that by no way, shape, or means do we believe, nor did I understand the prior speaker to be suggesting to you that because of the purposes for which they adopted it and the reasons they gave for using it should be a reason for you to embrace it. There are other agencies. Your 558 decision this week mentioned that you would be interested, as you think more about this, in looking at what other federal and state agencies and other entities do. You're getting this testimony from the Canadian Transport Agency, which we understand uses CAPM for certain purposes up there. Nobody has mentioned the Federal Energy Regulatory Commission, and I think we certainly ought to put them in the mix here. There is a sister agency that absolutely does have a charge to regulate rates and to determine investment costs, investment basis for pipelines, regulated pipelines, and my understanding is they do use a discounted cash flow methodology at that agency. Again, I'm not testifying on behalf of the FERC or about the FERC, but if you were to go forward with this proceeding in a more formal notice of proposed rulemaking, I would hope that you would reach out to the FERC and that participants in the proceeding would come forward and give you evidence about why FERC has used that methodology and how well it has served them. The Canadians, as you noted, are out here. Sorry they couldn't get out of Ottawa, but we at least know something about them. Two of the AR's members, obviously, are the two large Canadian railroads, Canadian National and Canadian Pacific. They were kind enough to point me to the CTA website, and I read some of the materials that that agency has promulgated about why it has adopted a CAPM and what it uses it for. I would say that CN and CP do not agree with the CTA's approaches. They have repeatedly petitioned the CTA to modify that approach. And I would also observe that, again, I'm not here to take to brook with the Canadian Transport Agency, but you would at least please take note of the purposes for which that agency goes through this process of trying to calculate the cost of equity. They have, as you probably know, a very unique system for pricing grain rates in Canada. It is what I would term a socio-political decision that the government of Canada has made to protect Western Canadian grain farmers. A legitimate governmental decision for the government of Canada, but basically the rates that CP and CN can charge those grain farmers are capped every year. They're capped almost by definition below at what a free operating market would allow. I don't believe that is a model that has anything to teach us here. You had a grain hearing here last fall. You know how robust the factors are that affect those markets, and we don't attempt to cap prices in those markets, and we don't attempt to cap the rates that the railroads here can charge. I'll be pleased to address some of the other issues that you had with the prior speaker, but I want Dr. Stengel to have some fair opportunity to address some of the points that he has for you, and particularly in the exhibits that I hope you have in front of you now. There should be a cover sheet that says exhibits in support of Dr. Stengel's testimony. It looks like this. Dr. Stengel.
I appreciate the opportunity to appear before you today. Thank you. I send greetings from Dean Hubbard, who regrets he couldn't be here due to some prior commitments he had at Columbia University. As Dean Hubbard made clear in his verified statement submitted in December, the cost of capital is an important, indeed vital determination that this board must make, and I agree with him in that, as I will try to explain to you today. I worked with Dean Hubbard on his December testimony, and he has reviewed the remarks that I previously submitted to the board on February 12th. The DCF methodology, discounted cash flow, is an appropriate and straightforward approach to estimating railroads' cost of equity, and it has served this board and the railroad industry well for over 2 decades. In short, the DCF is not, as some have suggested, a flawed technique. The regulatory cost of capital allowed the railroads increased from 13.2% to 15.2% from 2004 to 2005. This increase apparently caused the WCTL to complain that somehow the DCF model must be flawed. They didn't like that result. What the League and its witnesses overlooked, however, was that there was a real economic rationale for this increase in the cost of capital produced by the DCF model. As Mr. Motz just explained, economic conditions facing the industry have undergone changes in recent years. There's considerably increased demand, and there are capacity constraints. These factors underscore the value of the DCF methodology, which I consider, and Dean Hubbard pointed out in his statement, is a forward-looking measure. Compare this to the way the capital asset pricing model is implemented. In theory, at least, the CAPM is not backward-looking. It's a single-period model. But the way it gets implemented, it has to rely on historical data. And because of this, it needs to look back in time. And it depends on how you think the past, how accurate the past would be as an indicator of future market conditions. As as I hope to show you in a moment, the CAPM has only recently begun to reflect some of the changes in the industry that the DCF approach was picking up. The WCTL has also claimed that the railroad's cost of equity should be similar to the cost of equity granted to regulated electric and gas utilities. This argument, however, is contradicted by the sources on which the WCTL and its experts rely. I'd now like to direct you to Exhibit 1 in this handout. If you could take a look at that under Tab 1. And what I did here was I've quoted from the WCTL's December 8th submission. And they have some information there purporting to prove that the railroad's cost of equity should be more or less the same as electric and gas utilities. And as support for that proposition, they directed the reader to a website maintained by a professor at NYU. I went and looked on this website, and in fact, the sources there do not support this proposition at all. And I've reported some of the numbers in the top panel here, the top two panels on this page. In fact, I direct you to the 2004 numbers, and there, the first line, those are the estimates that the WCTL quoted or referred to. What they didn't refer to, which is also there in the same website, is that a 3-year regression beta shows something quite different. It shows the railroad betas are, by and large, considerably greater than the regulated utilities. Then the other thing that the WCTL neglected to point out was that more recent data for beta would indicate that the railroad beta, and consequently the railroad cost of equity, has increased considerably over the last 2 or 3 years. And for example, if you look at the 3-year regression beta for the year 2007, the railroad beta is now on this NYU website 3 to 4 times greater than the betas for the regulated utilities. So I think that that sort of information should refute this notion or myth that the rails are similar to regulated utilities. Another point I'd like to draw your attention to is about the CAPM, is that one of our panelists here, Professor Hodder, in his submitted testimony, suggested that the CAPM, quote, is not difficult to implement. I respectfully disagree with this position. In fact, the CAPM is subject to substantial, well-known academic criticism about implementation issues, which require a great deal of subjective and consequential judgments. If this board were to adopt the CAPM, it would need to make at least the following judgments. Which beta vendor would you rely on? Presumably you're not going to just do what the Fed did and say beta for the railroad industry is 1.0. That would clearly be wrong. I'd like to direct you to Exhibit 3 to show you some of the problems you would face. This is a table of betas drawn from 4 recognized vendors of beta, the risk measure. And as you'll see, Bloomberg, Ibbotson, Thompson, and Value Line all report vastly different numbers for the 4 major railroads. Take a look at Norfolk Southern. Ibbotson has a 0.91 value. Thompson has a 1.8 value for Norfolk Southern, approximately twice. Similarly, Union Pacific, Ibbotson has a 0.74 value of beta. Thompson, 1.57. You'd be faced with, how do you choose? Which one's right? Some of the other factors you'd have to decide about is what time period over which beta would be estimated. These vendors vary from 2 to 5 years. You'd have to choose what data frequency, weekly, monthly data. Which market proxy would you use? The market professionals who are vendors of this sort of information disagree on how to make these decisions, but you'd have to make a choice. I'd also direct you back to Dean Hubbard's statement, which he submitted in December, where he also presented an illustration of how fundamental beta is with respect to Black and Decker. And now I'd like to ask you to look at Exhibit 4 to illustrate how fundamental beta is to the cost of equity. What I've done here in Exhibit 4 is show you for reasonable input values for time period, data frequency, and market index, you get vastly different beta values and consequential cost of equity values. For example, Norfolk Southern, which shows the widest spread, depending on which time period you use, frequency or market index, you could get a beta of 0.7 to 2.5. And then if you look on the right scale, that would translate into a cost of equity between 9% and 22%. So there's a great deal of variation that beta can cause. Thus, I would submit that the CAPM is not easy to implement at all and would require the board to make substantial judgments to implement it properly. Let me underscore that the determination of beta and cost of equity has extremely significant real economic consequences for the rail industry, including its ability to attract capital and make substantial capital expenditures, the ones that Mr. Motes referred to. And these expenditures will be required over the coming years to increase capacity and maintain service levels. One last exhibit I'd like to direct your attention to is Exhibit 2. And this should be in color. And again, the rail industry is not a static industry. It would be a mistake to impose a fixed beta or fixed cost of capital on the industry. It varies over time, and this is a considerable sweep of time from 1990 to 2007. But over that time period, beta from Bloomberg has varied considerably. And recently, it's been increasing from 2004 on to today. Beta has increased from approximately a range of 0.6 to 0.8 to currently estimates are that beta is 1.2 to 1.5 or 1.6. This is a substantial increase. The dotted line that you see there, the vertical dotted line, is the point at which Mr. Crowley's analysis stopped. That was a period when beta was falling. And perhaps it may be that there was a significant difference at that point between what the capital asset pricing model results were showing and what the DCF model might have been showing. My guess is that those two models are now coming together, that the two models will be perhaps converging. But it does show that these estimates can vary considerably over time, and I think it would be a caution to you to not pick and choose or permit the parties to pick and choose which model gives them the best results at any given point in time. So in closing, I just wanted to mention that in addition to the merits that the DCF has in its own right, it also has the benefit of maintaining consistency in the methods that have been employed by this board over the past 2 decades. Thank you for your attention. I'd be happy to answer any questions.
Thank you. Mr. Motes, does that conclude your team's statement?
It does. We look forward to answering questions, but I think that's our time.
Very good. Now we'll move on to the Western Coal Traffic League, represented by Mr. Robert D. Rosenberg and Mr. James E. Hodder. Welcome, and please proceed.
Before I begin, I just got packages for Dr. Hodder's PowerPoint. I've also given them to Mr. Motes as well. Yeah, it's kind of cool. Chairman Nottingham, Vice Chairman Buttry, and Commissioner Mulvey, good afternoon. I am Robert Rosenberg, the Sloper Law Office, appearing on behalf of the Western Coal Traffic League. With me is Professor Jim Hodder, the Wisconsin Distinguished Professor of Business, and the Charles and Laura Albright Professor of Finance at the School of Business of the University of Wisconsin-Madison. On behalf of the League, we want to thank you for holding this hearing on the important issue of how to determine the railroad industry cost of capital. The division between us is that I will try to briefly address general matters, and Dr. Hodder will address more technical details, especially the intricacies of the DCF and the CAPM models. Some stuff may fall in between, and I hope that Dr. Hodder will make sure that what we say is correct and keep me out of trouble on those things. The League's position is that there is no single right way to calculate the railroad industry's cost of equity. Unfortunately, the board's present single-stage DCF approach is not one of them. When first, it utilizes an earnings forecast that is double the rate of growth in the general economy, and when second, it yields a 20% increase from one year to the next, unrelated to any significant change in inflation or the fundamental risk of railroading. The board's approach takes an average growth rate for the next 5 years and assumes that earnings will continue to grow at that rate in perpetuity. That approach may be sound where earnings are stable and the growth is sustainable because it tracks the general economy. It is not appropriate if the projected growth is double that of the general economy, as FERC, for example, has recognized. Such earnings growth into perpetuity is not plausible or sustainable. It is also especially inappropriate where the increased growth stems from the railroad's exploitation of their market power. Indeed, it's quite anomalous that the railroads should be allowed to charge more simply because they are earning more because they are charging more. That's circular and is poor regulatory policy. There are two primary ways to address the problem. The first is to use a multi-stage DCF model, which seems to be the AAR's preferred approach to the uncertain extent it acknowledges that there is a problem. Essentially, the analyst projections are combined with a sustainable long-term growth rate, such as GDP. Dr. Hodder's earlier verified statement gives examples of ways this might be done, and then the effects are substantial. The alternative is to use CAPM or some variant. Now, there is room for discussion as to which is better and when. Such questions are probably better directed to Dr. Hodder, but I'll add my 2 cents anyway. First, you can and should consider both, as they should come out pretty close, as Dr. Hodder demonstrated. Indeed, they came out fairly close 25 years ago. If and when they don't come out, then there's reason to reconsider and reanalyze, especially if there are big changes from year to year, as there was in 2005. Second, relying on the analysts' projections becomes a circular exercise because the analysts are, to a significant extent, forecasting the board's actions and policies. More importantly, the analysts' projections are not very compelling. In various cases in the 2005 data, the truncated average amounts to a few or even a single forecast. There are major spreads between the high and low forecasts for the individual railroads in single months, and there are also large swings in the truncated averages for individual railroads between months. Under the circumstances, CAPM deserves a pretty good look, as the Fed and the Canadian Transportation Agency have recognized. The League's comments also address the capital structure issue. This issue has less of an impact than the cost of equity, but is still significant and is driven by the same underlying factor, namely the rise in railroad earnings and stock prices. The 60% equity share seems excessive and contributes to the high cost of capital for 2005. The problem can be addressed in part by capitalizing operating leases, as is done by Wall Street, BNSF, and UP, and their presentations, and by using a multi-year average for capital structure to avoid excessive fluctuation due to what may be temporary variations. Beyond that, the cost of capital should be calculated using a more appropriate or optimal capital structure. As part of its initial submission, the AR should be required to defend its view as to what constitutes economical and efficient management under the statute, and other parties should have an opportunity to respond. I'd also note that the AAR has talked about what the board should do with the cost of capital. They said nothing about what the railroads themselves do in their internal calculations, what methods they use, what numbers they came up with. In our written submission, we attached some reports from Wall Street indicating that they calculate cost of capital figures, the weighted average cost of capital that are below 10%, and that's consistent with what we've been advocating in the proceeding for 2005. And with that, I'll turn it over to Dr. Hodder.
Thank you. First of all, I'm pleased to actually be here. That was a little bit of a challenge, but not too bad. I hope that my comments will be helpful for you. I'm going to focus on the cost of equity estimation issue because my perception is that is far and away the biggest issue that you have on the table. In thinking about this presentation, I'm trying to put myself in your shoes and ask what sort of information I would want if I had to make the decisions that you're required to make. And what I'm going to suggest is a framework for information and proceeding rather than a punchline of saying, well, the number is X percent. By way of a brief overview, I'm basically going to recommend three things. First, you have a problem with the current methodology because it assumes a constant growth rate forever. And when the growth rate of a firm or an industry deviates substantially from the growth rate of the economy, that single-phase DCF model generates results which are not economically plausible. And this is a very, very basic thing taught in an early finance course, that this model can create serious problems if you stick with a single growth rate forever. To fix that, I would suggest you mandate a multi-phase DCF model where if the current growth rate is estimated to be very high or very low for the next few years, you subsequently allow a transition to a growth rate that would match an estimate for the economy as a whole. That is going to generate for you estimates which are considerably more stable, more robust, and more reliable. Secondly, I would suggest that you mandate a second estimation methodology based on some asset pricing model. The CAPM is by far the most widely utilized, but in both my verified statement and in the comments from Dean Hubbard, there was a suggestion of the FAMA French model. That is an alternative. There's arbitrage pricing theory, which represents a third alternative. The basic idea here is that all three of these models are similar in the sense that they focus on first a risk-free return, which includes both a real return and an inflation adjustment, and then they add one or more risk factors on top of that. The approach is sufficiently different from the discounted cash flow procedure that you tend to get two differing perspectives with different inputs and different philosophy, but in the end, you should get out similar estimates because the cost of equity is the cost of equity. The models are estimating it imperfectly, but they should converge. If they don't converge, you get to point number 3, which is I would recommend that you require the parties to provide substantial justification for the inputs that they're using in the models. These models are very sensitive to the inputs, and when you get different answers, it's because you've got different inputs. I would suggest that you require them to discuss why an input has changed from the previous year. What is the underlying economics that caused that change? If it didn't change, you should also ask for a discussion of, okay, explain to me why it didn't change, because perhaps you are looking out there into the market and you're seeing that the situation has changed, and if the situation, let's say a leverage or capacity utilization changed, why didn't that affect some inputs? I would also recommend that you require a discussion of plausible ranges of inputs. There's been some discussion of the IBIS forecasts. Okay, you're using an average, but there are ranges. Why was a particular input chosen as opposed to the high or the low? Average is certainly a reasonable thing to do, but you should have some sense of what is the range of inputs that people are looking at. I would also suggest you ask for a comparison between the forecast and recent history of the particular input. And indeed, you can even do this on the entire cost of equity. The cost of equity is supposed to measure what investors expect to receive from investing in a security. And that can be compared with what they've received in the recent past. And I think the key issue here is that you should anticipate that there will be differences in the cost of capital estimates. But if the inputs used across the various models are consistent with each other, that difference should be relatively modest. If it's a % difference, I would consider that relatively modest. If it's 2%, you're kind of pushing the envelope. If it's 4 or 5, that's way too big a difference. And at that point, I would ask people to go back, or your staff, go in and look at those inputs and try to decide where those differences are coming from and what is the most reasonable alternative. Now, I actually have some slides here to sort of illustrate some of this stuff. And intuitively, what's going on with the dividend capitalization approach, or sometimes referred to as the DCF or discounted cash flow approach, is this was an attempt to get an estimate of an anticipated return for an investor in the stock. And the idea was the investor buys the stock today. We know what the price is. We'll call it P0. They're going to collect dividends for as long as they own the stock, and then they're going to sell it for some price, let's call it PT. Now, once you know that information, you can calculate their return. The problem is we don't know PT, and if we could forecast that with accuracy, we'd all be rich. So the people who were building these models said, well, okay, let's do a substitution here, and we will assume that PT is the present value at that future date of the subsequent dividends out to eternity, okay? And this is where this growth rate starts to come from. And in fact, what we're trying to do is we're trying to forecast future dividends, and the upper equation there basically is saying, okay, if I can forecast dividend in year 1, dividend in year 2, etc., and the dots at the end means it goes on forever, I could work out what K is. That's the internal rate of return, or the, well, what will ultimately turn out to be the cost of equity estimate. Now, the problem is I don't know what those dividends are, so I've got to have some forecasting mechanism. The so-called Gordon growth model, on which your current technology is based, assumes a constant growth rate forever. That's the G. And with that, you can collapse the top equation into a shorter form, which is the second one, where you're summing up those dividends assumed to grow at a constant rate on out to infinity. It turns out that infinite series has a relatively simple solution at the bottom, which says that the current price is going to be the current dividend times 1 plus the growth rate divided by K minus G. And then what you do is you rearrange that to get K, the cost of equity estimate. Okay, that one is the formula I just showed you was assuming annual dividends and a constant growth rate. Prior to 1982, your predecessor, the Interstate Commerce Commission, was using the equation, I guess I can point back here, was using, maybe I can't point that. The pointer's died. Oh well. The top equation, and the difference between that and the one on the previous page was that this one assumes continuously paid out dividends. And this was actually the formula that was in the paper written by Myron Gordon and Eli Shapiro. For reasons that I don't fully understand, but it's been described as using the average of those two formulas. Starting in 1982, the ICC and subsequently yourselves have been using the formula at the bottom, which is indeed the average of the previous two. The key issue here is that all three of these formulas, the results are very, very sensitive to what you plug in for G. And you can just look at this thing and you can say, well, you know, the first term is a couple of percentage points. The second term, which is the G, is whatever you plug in for G. If you plug in 13.66 for G, you're going to have some number bigger than that by 1.5 to 2%. Okay, so it's very sensitive to G. And the issue then becomes, well, what happens if you don't think it's going to grow at a constant rate forever? And the problem is that if the constant rate that you assume is substantially higher than the growth rate for the economy, you wind up with the result that the firm or the industry in question becomes the whole economy. They come to dominate everything. If they're growing at a slower rate than the whole economy, then mathematically they disappear. And so you say, okay, economically this doesn't make sense. How do I fix the problem? Well, the way I fix the problem is I have an initial growth rate for some period of time, say 5 years. So TA could be 5 years. So I'm going to use a 5-year forecast. It doesn't have to be 5. It could be 3, 7, whatever you think is reasonable. But I use something for the first period of time. And then I have a transition phase, or perhaps more than one, but here I'm assuming just one transition phase from TA to TB. Let's say TB is 10 years. So I have a transition from 5 to 10, and then after 10, I assume a terminal growth rate, which is normally set at the estimate for GDP growth. Okay, so if you do this kind of procedure, you wind up, here's the equation. If you don't like equations, you don't have to look. But the first line is you're growing at one rate. Second line is the second period where you're growing at a different rate. And the bottom one is that final terminal situation where you're growing at the same rate as the economy as a whole. And this can be solved. And this is, in fact, a very standard thing to do. It's in textbooks. Ibbotson and Associates actually publishes one of these. It's not rocket science. But the thing here that's important is that once you allow for not growing at the same rate forever, the differences can be very, very large. Okay, model, this is table 1 out of my verified statement. The model 0 here is growing at 13.66% forever. And you get the 15.18% cost of equity estimate that was the 2005 number. Now, if you decide, well, gee, I don't really think I can grow at that rate forever, and I used a GDP estimated growth rate of 6%, one can debate that, but you're going to get numbers from people typically in the range of like 5.5 to 6.5% currently with the current inflation forecast and so on. Anyway, I used 6%. I said, okay, suppose we have an industry growing 13.66% for the first 20 years, and then we drop down to 6%. Well, the difference is pretty large. The cost of equity estimate drops from roughly 15.2 to 10.2. You can play around here with different numbers, but the point is that once you say it's not going at the same rate forever, you get numbers up here. The difference between Model 1 and Model 6 is a little over 2%. You get a much closer range for the estimates that are coming out. Now that's the, if you will, the benefit of suggestion 1. Suggestion 2 was you mandate a second approach coming from a different perspective. Here I've got the capital asset pricing model laid out. It's a risk-free rate plus a risk premium. And there's not too much issue about how to estimate the risk-free rate if you're worried about a long-term cost of capital. Because when you go for a long-term cost of capital, you want built in there the market's forecast for inflation over the long run. And that's fundamentally the reason or the rationale for using a longer-term risk-free rate, like a 20-year rate, as opposed to the 90-day rate, is you want the 20-year inflation expectation as opposed to the next 3 months. The problem or the issue with implementation is not whether it's hard, it's whether you can agree on the beta estimate and the market risk premium estimate. You can get forward-looking beta estimates. You can get adjusted betas. You can get estimates for the price of risk, but people are going to disagree about what's the right number to put in there. And a mechanical procedure is going to potentially get you some unusual answers. Okay, now The Fama-French model, which has been mentioned, is a variation where there are three factors. Arbitrage pricing theory, there can be three factors or more than three factors. But the technology is similar in the sense that you start with a risk-free rate. You say, okay, how much of a risk premium should I have? How much should the sensitivity be? And the betas here, I've got three of them, are the sensitivities to the different factors. And then the ER1 minus RF is the risk premium, or the price of risk, if you will, for that factor. Now, the benefit really for comparing a result like this for the CAPM with the discounted cash flow approach, especially if you're using a multi-phase version, is you start to see where the disagreements are coming from, and then you can drill in and try to make some sense out of, well, okay, what is the most reasonable input estimate? Do those input estimates line up with what we're seeing actually happening with the firms in the industry, and with the best forecast we can get for the near future? And with that, I will conclude, but be happy to answer any questions you may have.
Thank you.